How's it going, everybody? It is Dennis, and we're back with another video talking about XDTE, QDTE, YMAX, and YMAG, and how these funds from Roundhill and YieldMax should be the fundamentals of, or the fundamental basis or base of your portfolio. Of course, this is not financial advice, making sure that clear right after I make that statement. This is my financial opinion and my opinion from my portfolio and the way my portfolio has been going. But I believe that QDTE, XDTE, YMAX, and YMAX should be the base to everybody's dividend portfolio, especially if you're a high-yielding dividend player, and if you're a high-yielding dividend player who uses margin. These four positions should be your main positions in your account, and that's why I'm adding more and more into them, because I believe this will be the fundamental to my account, which will grow in my account and bring safety to my account and portfolio. So the reason being, for QDTE, XDTE being my choices, as you can see, QDTE right here, we have 31.29% yield. For XDTE, we have 29.77% yield. For YMAX, we have 65.04%. And for YMAG, we have 70.31%. Before we even look at these distribution rates, these are skewed, of course. These are based on the most recent distribution, which, of course, is based on the value of the stock that it, or the ETF at the current price, and the amount distributed. And of course, it could be changed around and move every single day, every single week, depending on the distribution it pays. So these numbers I wouldn't pay much attention to. I'll mostly pay attention to these numbers that are provided by Stock Analysis. I love using this website. It's free, not sponsored. But as you can see, 44.38% distribution from QDTE and a $15.20 distribution so far annually. Then we look at XDTE. We have from the dividend side 31.64% average yield and a $13.58 distribution. Then we look at YMAX, and the dividend from there, we have 64.55% dividend yield. So if you take a look at YMAX is 65, it's pretty similar to that. And $8.58 so far distributed annually on average. And of course, then we have YMAG, and YMAG is 51.79 and $7.66. So really big difference from the 70.31 that they're claiming on a website. But of course, like I said, this is skewed depending on the current distribution for the week, is what the distribution rate is up here. But we could see on average, it's 51.79% as stated by Stock Analysis. So why are these funds my main funds in my portfolio? Well, of course, XDTE is not my main portfolio, and YMAG is not in my portfolio. Currently, I hold YMAX, and I hold QDTE. QDTE for the QQQs and for the 0DTE strategy, and YMAX for having overall funds that YieldMax has, such as Airbnb, Misty, and all these funds go into YMAX, so it's diversified into single stock ETFs that they have, instead of just investing into each one separately. I have a diversified portfolio, which gives me diversified income, and as well as is growing and growing over time, and is not limited like YMAG, which is limited just to the MAG 7 and the performance of the MAG 7. So with that stated, we know the distribution rate, we know how much they've paid on average. Why am I choosing these in my portfolio? Well, I myself use margin. As you may or may not know, I trade options. I use margin for, say, income to pay for any bills I might have, which I'm currently starting up right now, or to just reinvest into the portfolio and expedite the process of my growth using margin in my portfolio. Of course, doing that safely as possible, and these funds contribute to that safety. The reason why I chose these funds is because you take a look at QDTE. You can see right here on the screen, I have a good chunk of money invested into it. I have my portfolio diversity is 14.75%, and the maintenance requirement for QDTE is 25%. We take a look at XDTE, not invested into XDTE, but we take a maintenance ratio on XDTE. Maintenance requirement is 25%. If we take a look at YMAX, again, good chunk of money invested into YMAX. I actually bought more today of recording this video on Thursday, and I have 14.32% in YMAX and a 25% maintenance ratio. Take a look right here. I'm not, like I said, I don't make these videos based on bias and based on not actually doing what I speak about. I actually bought $1,141 more of shares in YMAX. The reason being is because I took profits out of my LEAP contracts on SPY, took profits out of that, and put it into YMAX. It increased my margin buffer, and it increased the amount of shares I have, which increases the amount of distributions I have, and also allows me to weekly compound. I still continue to trade my LEAPs, right? Because all I did was I just moved it up while keeping on the same date, right? So I had a March 20th contract. I moved it up to instead of 540 to 555, got $1,000 out of that, harvested $1,000 in profit, and kept in my position, allowing me to continue to trade covered calls on that position. Of course, I take more risk by moving it up in case the S&P drops again by roughly 7%. Then it'll be a little bit tough for me to create income because, of course, then I have to trade lower, and I cannot trade lower than 555. But assuming that doesn't happen, assuming we continue to trend upwards, and assuming we don't have another 7% downfall or 10% downfall, and no tariff news is announced, everything should be nice and dandy if we stay around above the 555 mark. Of course, continuing, this is not an options video. This is a video about these funds, these dividend funds. We take a look at lastly at YMAG, which has 30% maintenance ratio. As you can see, YMAG has actually 5% higher than all the rest of them because it's the least diversified. YMAG only has 7 single stock ETFs that YieldMax trades instead of all the other ones like QDTE has all the QQQs because it trades on the QQQs. XDTE that trades on the S&P has all the stocks in the S&P. And of course, YMAX has all of the diversity of YMAX ETFs, right? Or YieldMax ETFs. Another reason why we choose this is because we could just take a look at the charts. Let's take a look at how YMAX and YMAG perform compared to the S&P. 13.81% compared to 12.84%, and 15.64% compared to 12.84%. We could see YMAX performed roughly a percent more than S&P 500 to date, and YMAG performed roughly 2%, 3% more than S&P to date. Of course, you might be saying, well, why don't you choose YMAX over YMAG? Or sorry, YMAG over YMAX if it performs almost 2% better than YMAX? Well, like I showed before, the maintenance requirement is also of 5%. That 5% is a good chunk of your margin if you are using margin. So keeping margin maintenance as low as possible is really important in portfolios like I have and other people who are trying to use margin to increase their income, increase their returns, and speed up their portfolio growth. So this is YieldMax. We can see YieldMax performs better than S&P 500. We take a look at QDTE and XDTE. QDTE 11.14% compared to 12.84%. It's a 1% lower, but it's still pretty reasonable in the range of S&P 500. XDTE 8.81%. So it is lower than S&P 500. So you can see this is one of the reasons why I don't have XDTE. It's because it just performs lower and worse than S&P 500. Of course, it trades on S&P 500, and in that sense, it's kind of safer than QDTE, and QQQ has mostly tech-based stocks. But I still prefer QQQ with its diversity, with its return of 11.14% compared to 12.84%. And of course, you might be asking, what about RDTE? RDTE is also by Roundhill ETF, and there's also RDTY from YieldMax, but that one has not been out long enough for me to really take a look at. There's also RDTE. What about RDTE? Well, RDTE performed 4.47% since inception. It came out a little bit later than QDT and XDT, so therefore we have a shorter time frame. It's not on a 1-year time frame. It's since September 10th, which is around the time it came out. Since then, it's performed 4.47% compared to S&P's 8.65%, so it's half of what the S&P has performed. Of course, there's still time for it to see what it really could do and how it could really outpace, but currently where it stands, it is performing worse than the S&P 500, and of course, usually that's what it is because Russell has less premium, less movement, and all of that sorts. So, how does this go into your portfolio? How can you use this in portfolio? Well, like mentioned before, maintenance requirement. Maintenance requirement is very important if you're using margin. If you take a look at my portfolio, let's go ahead and look at my portfolio. We can actually go ahead and take a look at my maintenance requirement, right? And let's go ahead and scroll down if everything could load in. So we take a look at the maintenance requirement, 23.39%. Oh, there we go, it clicked in. 23.39% is my margin requirement. So this was 21% just before I sold out of my option leap. So before the leap, before I moved the leap upwards, or I rolled it upwards and gave my $1,100, it was at 21%. Now it's at 23%. I took that money and threw it into YMAX, and I continue to have my 23.4%. Of course, it dropped a little bit more. I think it was at 24%, and it dropped to 23.4% because, of course, cash has 100% margin. 100%. It has no margin requirement. So of course you would have more margin with cash. compared to YMAX, which has 25%, compared to none from cash. So it dropped from 24 to 23.4. So we increased our margin requirement by 2%, doing that move by transferring the options over, rolling it upwards and getting $1,100 out of there, and therefore we increased our margin requirement. So we're sitting at 23.43%. This is lower than I want. I was sitting roughly at 32 just a couple months ago, before, of course, everything happened with the tariffs and everything of that sort. So, of course, since then, my margin requirement has dropped, but I'm building it back upwards and trying to get back there again. Like I mentioned in other videos, my option portfolio, or the option side of my portfolio, does take a good chunk of percent of my account, and I'm slowly trying to move out of that, trying to take the cash that I earned from the poor man covered call strategy and put it into more stable ETFs such as SPYI, JEPQ, maybe YMAX and QDTE. Of course, they're not as stable, but of course they provide dividends to offset it. And if we take a look, of course, like I said before, I've been investing into YMAX QDT for a while. I've had YMAX back in 2024. As you can see, I've earned $1,571.83 from YMAX so far since 2024. This is at the end of 2024. I had $1,571.83. And from QDT, I earned $1,206.50 by the end of 2024. And you could see that I owned these funds. So let's go ahead and take a look at QDT. When did I start QDT? In June, I started holding QDT. And then with YMAX, we started holding YMAX in March of 2024. So I've been holding YMAX for almost a year. We actually should make a video on that very soon. You holding a YMAX for a year and how it's performed. And QDTE, we're going to be hitting a year. I think we actually hit a year, right? We hit a year this month of June of holding YMAX, or sorry, holding QDTE. And if we take a look so far how they've been performing in 2025, 2025, YMAX has paid us $2,040, and QDTE has paid us $1,184.88. So, of course, 50% of that, roughly, or 50% was invested back into YMAX. So we're down so far on 50% was invested in QDT and 50% was invested in YMAX. So with that 50% reinvestment, assuming that those dividends that did we reinvest did also lose value, we're down $1,483.23. So we're down $1,408.23 on QDT. We've made $1,184.88 from 2025, and we've made, where was it? $1,206 from 2024. So in total, we made roughly like $2,300, $2,400 from QDT, and we're down $1,486. Of course, divide that by half, and then technically it balances itself out with a little bit on top, because of course we did reinvest a little bit back inside, but that's what you do to continue to grow the share count and keep your dividends up in case of the NAV erosion, which of course they experience. There's, these ETFs will experience NAV erosion. A lot of people on Twitter, a lot of people on social media are like, oh, but they experience NAV erosion. They experience NAV erosion. Of course, they're paying you dividends, right? They're going to experience NAV erosion. And of course, you could combat that by reinvesting 25%. You can reinvest 50%. You can reinvest 100%. Whatever you want to do. You take a look at the chart, right? If you reinvest 100% back in, you get 13.81% return, right? That's reinvesting 100% of your dividends back in. That's assuming you're not buying in more at, say, at better timing, right? So when the S&P is down, you could buy in. When, in general, whenever you see chances to buy in, you could buy in, right? It's just not like you're just limited to reinvesting. So that your performance could be way higher if you're buying in at you say at better times. It can't be perfect times because you can't time the market. So assuming you're buying in at good times, assuming you're reinvesting all your dividends, you would be at 13.81% or more, right? Say you half that, so you reinvest only 50%. Now you're, instead of 13.81%, you're earning roughly 6 to 7%, right? 6.5% roughly, or 6.75% if you want to be accurate, right? So 6.75% you're earning on YMAX, and the other 6.75% that you would be earning on return goes to your account, goes to your pocket if you're deciding to pocket that income. Or if you're taking that income and reinvesting into something else long-term like the S&P, right? You could always take the dividends and put it into the S&P, or put it into, say, all the Misty lovers. You could take YMAX and put it into Misty. You could take YMAX dividends, 50% of it, and go ahead and use it on whatever you want to use it on, or take half of YMAX dividends and go ahead and put on options that you want to play, right? Many things we could do with this. That's the great part about these funds. You take a look at YMAG. With YMAG, you could literally have, 7.75%. You could take out, and you could use on whatever you want. So a lot more than YMAX, right? If we take a look at QDTE, you could take out roughly, what is that, 6.5% of QDTE. You could take out 4.5% or 4.4% of XDTE if you want. So it depends on what you want to do with your portfolio. It's definitely possible. You could take out 75% of your dividend income and only reinvest 25% back in. And yes, your return will be less, but you still will be profitable in the long term. You'll still be profitable by what say 11.14%. You'll be profitable by like 3%. All right, by the end of the year, and then you'll have the 7% or 8% roughly, like around, 8.5, 8% roughly in dividend gain, right? So 3% in growth and 8% in dividend you receive, or 8% of that growth you take out in dividend, right? So it's possible to do, and it's a lot of people are doing it, and it also helps you keep your margin requirement up, right? Because if you're taking out margin and you're paying 5.5% interest, right, and you're taking your dividends out and you're paying that interest down while also keeping cash and while also growing the portfolio, it's great ways to have everything, right? You have your dividends, you're paying your margin down, and you're having growth. You have three things that everybody wants, because the margin expedites the amount of growth you have, right? Margin expedites the growth because it's not your money. You're paying that margin down, or you're paying the margin interest down. You're not paying the margin down, you're paying the interest down, right? And you also have growth. And when you have growth, right, that means you can take out more margin. You take out more margin, you get more dividends. You get more dividends, you could still continue to pay down the margin, and you continue to grow your dividend income. Three things that are perfect for anybody who's trying to get dividend income, who's trying to have growth, or somewhat growth. Of course, like I said, if you're taking out 75%, you're taking out 50%, you're not going to be doing as well as the S&P at 12.84%. You'll be doing less, but you are making dividends. So it's like I say it all the time, the great things about these funds is that you're able to change them to however you want to use them, right? You want growth? There you go, 13.81% compared to 12.84%. Who says there's no growth, right? It's right there on the charts, right? It's right there on the charts. Everybody on Twitter or social media says, look at the charts. I'm looking at the charts. It shows you right there, 13.81%. So there's growth if you want growth. If you want dividends and growth, there's dividends and growth. If you don't want any growth at all, then you just take dividends, right? But of course, it's recommended that you do reinvest something back in, so you continue to keep your share of growing your share count and keeping the dividends stable, right? Because there is NAV erosion if you don't reinvest back in, right? If you don't add back in, and those dividends, the dividends that you earn erode because the value of the shares erode, right? Because you're going down 13.37, right now on YMAX, then it goes to 13, then 12.5, then 12, right? That 50% that it's paying out is not going to be 15 on 13.37 dollars per share. It's going to be 50% on $12 per share, 50% on $11 per share, right? So you just got to look out for that. You got to look out for that. You got to look out for that dividend erosion. The way you counter dividend erosion is you reinvest. So then you have actually share growth that outpaces the dividend erosion. And you can do that by investing 25%, 50%, depending on what you hold and what your growth that you want from your portfolio. So once again, a lot of things you can do with these funds. The way I'm using these funds is I'm reinvesting 50% back into the funds. So 50% back into YMAX, 50% back into QDTE, and the other 50% goes to SPYI and JEPQ and other things that I want to invest to depending on the week and the month, right? Say S&P might be a little bit high. I don't think I want to put money into S&P. I could put money into, say, AMZ, Tesla, AMD, Misty if you're a Misty investor. I'm not a Misty investor, but you could take these funds and invest to other positions that you find more valuable at the time or undervalued at the time, and grow those positions. Of course, you take a look at my portfolio. My portfolio is not so large, right? I don't have a large portfolio, 41, right? I don't have a large portfolio, so my dividends are quite small comparative to what other people can earn, right? It's not that, what's the word for it? It's not that impressive when you look at it, right? $296.55, 65 cents. Like, what's the big deal? A lot of people, that's not enough for them to keep up their lifestyles or anything of that sorts, but we made 2,000 on the month of May, right? And it's not that grand, but of course, the more shares you have, the more grand it becomes, right? You have 1,000 shares of YMAX, it pays 20 cents a week. You're making, what is that? $200 a week, right? Math's correct. Yep, $200 a week, right? You're making $200 a week. That's $800 a month that you're making from YMAX. Say you have QDTE, you have 1,000 shares of QDTE. it pays also stable around 20 cents. You're also making $800 a week or a month, right? Of course, QDTE is more expensive than YMAX, and therefore it takes more money to buy those shares. But I'm just giving you examples. So, yeah, that is YMAX, that is QDTE, that is Roundhill and YieldMax ETFs, and that is how I'm using them in my portfolio. I'm using them as a base. Imagine I have a triangle, right? I have a triangle. We always, you know how you have triangle for food and everything of that sort. So they teach you when you're younger, and just in general, the pyramid of how everything works, right? QDT and YMAX are on the bottom, with of course SPYI and JEPQ and SGOV and everything of that sort. But QDT and YMAX are on the bottom. Those are the base of my portfolio. They bring me weekly income. They bring me weekly stability. That I'm able to use that income. Say I need to cover an option that went wrong, right? I have to buy back an option because it went wrong. I have that base to cover it. And then above that, we have, of course, stuff like BTCI. We have things like, let's say, I don't know, FEPI. Or people would say that's stable. I don't, yeah. Then you have things like, above that, you have things like AMZ. You have things like AMZ, Apply, GUI. Then you have Tesla, Misty, all that sorts. And above that, of course, is options, so like personal options. So on the tip of that pyramid is options, right? For me, it's trading leaps on the S&P. So that's the tip of my pyramid, and then the base is what provides everything to that tip, and that tip is able to earn me most of that income, right? But everything's proportional, you know. YMAX earns proportional to its value. The leaps earn proportional to its value. And everything comes down to the base, right? So you trickle everything down to your base, right? You trickle down the option income to the Tesla, AMZ. From Tesla, AMZ, or Misty, you go down to AMZ, or sorry, from Tesla, Misty, and whatever, you go down to AMZ, Apply, GUI. From there, you go down to FEPI and BTCI and everything like that. And from there, you go down to SPYI, QDTE, YMAX, and all that sorts, right? So that's the basis. And of course, under all of that is just cash, if you want to really go into it. But that's how I'm using QDT. That's how I'm using YMAX, XDTE, of course, I don't own, and YMAG I don't own. And I gave you the reasons why. Of course, YMAG does outperform YMAX, but in general, it has 5% more margin requirement. And that sounds small, but it's not. And also, it does have MAG 7, and you're depending on the MAG 7. And I don't really want to depend on the MAG 7. I like the diversity of YMAX and what that offers. And of course, like I showed before, RDTE, not that good of a performer, and QDT is just way better than XDTE. So QDT and YMAX are my holdings, not financial advice, but that's just what I'm building my base on. You saw it's almost 30% of my portfolio is YMAX and QDTE. And yeah, now continue to add into them, continue to grow them. With the current share count that I have on YMAX, right, is 780. It is, I estimate that if we continue to get 0.20 every single week, or not even, if we get like say 0.17 every single week, I should be able to get a good $600 clean every single month if we're getting 0.17, 0.20 roughly a week, right? So I'm going to be getting $600 clean. That $600 goes in and gets reinvested, gets put into other places, grows my margin buffer, grows my margin amount, and therefore just continue to do that over and over and over and over again. So yeah, that is that. And thank you so much for watching. That is how I'm building a base with YMAX and QDT. That's just my take on it, and why these four could be great bases for anybody's portfolio. Of course, if you don't have that much risk tolerance and you don't want to get into them because NAV erosion and it's scary, I fully understand. You stick to SPYI and JEPQ. Of course, they have lower yields and they're monthly. But if QDT and YMAX are not your cup of tea, then it's not your cup of tea. But if you're investing into Misty, definitely take a look at QDT and YMAX being a place for you to store some of your income that you're earning from Misty, which then you can siphon back into Misty on a weekly basis if you need to. So once again, thank you so much for watching. I'll see you guys next week for next week's video, which actually gave me an idea by making this video. We're going to talk about, I guess, how YMAX and QDT have been performing in the year time frame that I've owned them. So another QDT and YMAX video coming up next week. So yeah, see you guys next week for next week's video.